Welcome. Let's get right to it. This isn't just another market update. Think of this as a strategic briefing. It's for those of you who know how to look past the day-to-day noise to find the real signal. Today, we're going to dissect a major event in the silver market, and we're going to pull out the actionable intelligence that the headlines completely missed.
So this is the number that flashed across every screen, -8%. The media called it a crash, a failure, a reason to get out. Well, they're wrong. This number isn't a judgment on silver's real value. It's a signal, a carefully crafted one designed for a very specific purpose. Our job today is to decode it together.
And we're going to be very methodical about this. First, we'll tear down that 8% illusion. Then we'll get into the huge disconnect between the paper price and what's happening in the physical world. That'll lead us to 4 key pillars of evidence that frankly make the case undeniable. And finally, we'll connect the dots to the geopolitical endgame and boil it all down to one clear signal for your strategy.
All right, let's start by taking this event apart. To really get the signal, you have to ignore the price chart for a minute and look at the environment where this drop was actually created.
The first question a strategist always has to ask is this: was this event organic or was it manufactured? Was it a true reflection of reality changing or was it a calculated move on the board? The answer to that changes absolutely everything.
So just think about the profound lack of a reason here. Real market crashes are triggered by real-world events, but in this case, there was nothing. Industrial demand didn't suddenly dry up, mines didn't announce massive new discoveries, no government sold off its strategic reserves. The drop happened in a complete vacuum, which tells you right away the cause wasn't in the real world. It was in the financial one.
And this brings us right to the heart of the conflict in precious metals. It's this growing, widening gap between the price of a paper contract and the actual value of the physical asset you can hold in your hand.
You have to understand, we're talking about 2 completely different worlds here. On one side, you have the paper market. It's all abstract, driven by leverage, algorithms, and speed. But on the other side, you've got the physical market. This is the world of reality, governed by actual scarcity and the simple fact of possession. That 8% drop, it was a battle fought and won entirely in the world of paper.
It's so important to get this. The paper market is a financial casino built on top of a physical asset. It allows for claims on silver to be traded often hundreds of times more than the actual metal that even exists. The goal isn't delivery of the metal. The goal is just cashing in on price moves.
Now, the physical market is, well, it's brutally simple. It's about getting and holding a resource that there's only so much of. The price isn't some number on a screen. It's what it actually costs you to get that metal into your possession. Now, these 2 markets are supposed to be connected, but that connection is now under incredible strain. Okay, so this divergence, this isn't just some theory. We can actually prove it by looking at 4 very distinct pillars of evidence. This is where you can really see the signal cutting through all that noise.
So our first pillar looks at how the price drop actually happened. This wasn't a bunch of scared investors selling off. No, this was a tactical operation. Look, the timing was just too perfect to be a coincidence. The event happened right around a major options expiration date, a time when big financial players have a huge incentive to make sure the price closes below a certain number. And the method? Classic textbook stuff. They dump enormous sell orders when trading is thin to get the biggest possible price drop. That is the signature of a calculated move, not a market panic.
So what's the takeaway here? It's simple. We are not looking at a reflection of silver's true value. We are looking at a confession, a confession from a large, over-leveraged player that had to slam the price down to manage their own risky position. This was self-defense, not a verdict on silver.
Now, this second pillar is probably the most revealing. It's how the real world reacted to this paper price drop, and it just completely blows up the official story.
While the paper price was falling off a cliff, the actual cost to get your hands on physical silver was going up. Premiums, that's the amount you pay over the spot price, they ballooned. Dealers started posting out-of-stock notices and warning of delivery delays. This is the exact opposite of what happens in a real crash. In a real crash, everyone's trying to sell. Here, supply just disappeared.
The physical market didn't see a crisis. It sought a Black Friday sale. The smart money, the accumulators, they knew the price was fake and they jumped on the opportunity. Demand for the real thing surged precisely because the paper price was being pushed down.
All right, our third pillar. Let's pull the camera back and look at the global picture. Because what we're seeing is a massive transfer of physical wealth from one part of the world to another.
What's happening is what we call a great rotation. The suppression of the paper price, which is mostly happening on Western financial exchanges, is creating this amazing discount. And that discount is being snapped up by physical buyers, mostly in the East. The data is crystal clear. You have two totally different strategies playing out. The West is selling paper promises, while the East is busy turning those promises into real physical metal. This is the classic transfer from weak hands to strong hands, but now it's happening on a geopolitical scale.
And this has a very real long-term consequence. By offering silver on paper at a discount, Western vaults are literally being drained of their physical supply to make good on this arbitrage. The system itself is punishing the illusion by moving the real asset to people who are playing a much longer game. Okay, our final pillar is a psychological one. We have to understand the emotional goal of a sharp, engineered price drop like this. What is it designed to make you feel?
This volatility isn't a bug, it's a feature, it's a tool. It's engineered to create fear and doubt in you, the individual investor, to make you second-guess yourself, to panic, and to sell your physical holdings. And that selling is exactly what allows the larger, more patient players to scoop up your assets at that artificial discount. For the prepared investor, these moments are not threats, they are opportunities. They are predictable moments of manufactured chaos that allow for smart accumulation. Once you understand this, your entire perspective shifts from being reactive and fearful to being proactive and strategic. So when all this physical supply starts getting drained and moved around the world, this story stops being just about markets. It becomes a matter of national interest. And that forces us to ask a bigger question. How does all this affect how governments are thinking? Here's the truly contrarian insight. This prolonged price suppression and volatility, it's the very thing that's going to force governments to reclassify silver. It's going to stop being treated as just another commodity and start being treated as a strategic national asset, one that is absolutely critical for industry and, by extension, for national security. And history gives us a perfect roadmap for this. When a resource becomes too important to be left to a volatile financial market, governments step in. We saw it with gold, we saw it with currencies, we've seen it with rare earth metals. The pattern is there. For industrial nations, the stakes are just too high to let this continue indefinitely. So here's what you need to be listening for. Listen for a change in the language coming from official sources. When the conversation shifts from market prices to words like supply security, onshoring, and strategic reserves, you are hearing the early stages of a massive policy shift. That's the signal that comes before they make their big move.
And it all boils down to this one question. For a metal that is essential for everything from solar panels to satellites to defense systems, when does its price become a national security issue? The answer is the moment its physical supply can no longer be guaranteed by a broken paper market. And we are getting very, very close to that moment.
Okay, so we've covered a lot of ground. What does this all mean for you? How do we take all this complexity and distill it into one single clear signal for your strategy?
This is it. This is the golden nugget. As the paper and physical worlds continue to break apart, that paper price on the screen becomes more and more meaningless as a measure of real value. The only thing that's going to matter in the end is physical ownership. The signal is to prioritize having the asset over watching the price.
And this insight needs to become a discipline. First, you have to train yourself to see that gap between the paper price and physical reality. Second, always analyze the motives behind these big moves. Ask yourself, who benefits from this? And third, position your portfolio based on that physical reality, not the paper illusion. That is how you stop being a spectator and start being a strategist.
Before we wrap up, there's one final and most important point we need to cover about your own financial path.
Before we depart, remember, the financial landscape is constantly shifting. The insights shared in this video are for educational and informational purposes only. They do not constitute financial, investment, or legal advice. Every investor's situation is unique, and you should always consult with a certified professional before making any significant financial decisions. Our goal is to help you find the signal, but the final move is always yours. Stay sovereign, stay informed.